You are the real estate investor, and syndications or active real estate, whatever. You have $1 million. Well, pretty easily, you can earn, let's say, 7% cash on cash return off of real estate. So you're at $70,000. So you're already winning. And then you're not going to have to pay taxes if you do things right legally.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Jim Pfeifer. Jim has dedicated his career to helping educate and advise people on finances and investing. He's a full-time passive investor. I'm excited to actually talk about that. Very, very interesting. Former president of Left Field Investors. Jim is passionate about empowering investors with accessible education and community networking opportunities. So, Jim, like I said, I like to let you kind of tell the story, paint the picture, whatever phrasing you want to use. But first, thank you for being on the show. Thanks for taking the time out to chat with me today. I'm very excited to get to hear your story and dive in there. So thanks for being here.
Yeah, well, thanks for having me on the show, Jason. I appreciate it. I'm excited about what we're going to talk about today.
Awesome. Well, let's start with your story, your background. Tell us about yourself.
Okay, sure. I've always been interested in finance. I was a finance major in college. Right now I'm on career number 6, I think, if you count that far back. I started, my first job was just a regular business job. I was a reinsurance underwriter, and I was super excited because I wanted to jump in and start investing in my 401k and all of that. So even right out of college, I was super into that because I was pretty confident that the best way to create wealth was through the stock market, mutual funds, stocks, that type of thing. And so that's really what I did as far as investing for my first, 15 years of my career. So, after about 11 years, I quit business and I became a teacher teaching finance and accounting to kids in the Columbus City School District. So it was really a lot of life skills training and things like that. And man, teaching was hard. That was a big challenge, but I was still really interested in my investing, and I'd been through ups and downs, on the investing. And then we built a house. We had our third kid and built a new house, and it was 2008. So we could not sell our old house. And that's when real estate enters the picture. For me, I became an accidental landlord, and I absolutely hated it. I did not like managing the tenant in my old house, all that kind of stuff. I had a great tenant, phenomenal. Made me take my shoes off to come into my own house, but I still just didn't like it. But I liked what it was doing financially. And so slowly over time, I ended up, I had that house paid off, and I went to sell it after the market kind of corrected, a few years later, maybe 2013 or so. And my real estate agent said, why are you selling this house? It's in a great neighborhood and all that. Why don't you take a loan out on it and get 2 more, and I'll manage them all for you. And I had seen financially what real estate was doing. So I was like, you know what, that makes sense. I have 1 cash flowing asset. I can turn that into 3 cash flowing assets. And so after that, I was kind of off to the races. I eventually stopped being a teacher and transitioned into becoming a financial advisor, which also that kind of happened at the same time I was really getting into real estate. And, when you become a financial advisor, they like to pretend you don't know anything about finance, and they just reteach you. And the more they were teaching me about finance and how money works, I was seeing it applied to my real estate assets. And I'm like, well, that's a lot better than this speculative stuff, these paper assets, where basically, and I'm going off a little tangent here, but speculation, right? Paper assets, you invest in those, you get no current benefit. You're just hoping to sell it to somebody else for more at some point in future. But I was looking at real assets, the real estate that I owned, and I had a current benefit, cash flow. Right. And then I could also sell it to somebody later for more money. So I was just off and running. And then I left financial advising because I found that I wasn't investing in what I was putting my clients into. And that was a disconnect. I always prided myself on investing in the same stuff as my clients. I couldn't recommend real estate. I couldn't put them into real estate because I wasn't licensed for it. and I didn't get compensated for it, right? So eventually I became a full-time active investor, but at this time I was telling people I was a passive investor because I was buying properties, single families and a few multifamilies, but I hired a property manager to manage it for me. And so I thought I was passive. But, ask my family, they're like, why are you always on the phone with your property manager screaming at him to, you know, charge less on a rehab or not evict a tenant or doing all this? I was active, but I called it passive, right? And that's, I did that for a few years and I was a terrible asset manager. None of the properties, except those first three suburban properties that I got into, all the rest, none of them really ever cash flowed. And I couldn't figure out what I was doing wrong. And I just thought it was the property managers, and partially it was. And then I found this thing called syndications where I could invest and be truly passive. Now it's still active on the front end, and we can talk about that, but you're passive, right? I hire a professional asset manager. That is all they do. Their full-time job is to make sure that my asset performs. And what I found was my returns were probably better, right? Certainly the cash flow was, than I was doing it on my own. And, the return on stress or however you call that
Yep.
was
Yep.
less because I had a professional managing these assets. And so, the thing is with an active investor, I think to be a good active investor, you have to have something that other people don't. Either you're really good at rehab and you know how to swing a hammer, or you know a market better than anyone else, something that sets you apart. I didn't have anything except I just wanted to be in real estate. So real estate syndications became my full-time thing. This was around 2018, 19, and then 2020 I decided to start a little mastermind group, just to help to learn, right? Because it's very hard to learn about alternative assets and how to invest in them without having a community. And so I had this little mastermind. Our first meeting was going to be March 18th, 2020. And that is when the world shut down for COVID. So we did not meet for our little dinner club. We went online to this new technology called Zoom, and that was the beginning of what became Left Field Investors, a community of 2,000 limited partner investors. And we built up the community and kind of started on accident, but we built it up over 4 years. And eventually, we kind of ran into Bigger Pockets, who was looking to find a way that the people that quote unquote graduate from Bigger Pockets, meaning they're successful active investors and they want to transition to be more passive, then they would leave the platform. So Bigger Pockets wanted a passive platform, and so we partnered with them to form Passive Pockets, and that's what I do now. I'm the podcast host of Passive Pockets, and I work with LPs, and I'm just really into the community. I think the number one way to be successful as a limited partner investor is to join a community. Any community, multiple communities. It doesn't have to be ours. I'm biased. I think ours is the best, but there's plenty others out there, and you just got to find one that the culture of the community works for you. So that probably went way too long, but that's my story.
No, that's perfect. That's exactly what I want. That gives us a lot to talk about too, because I think that there's an evolution of kind of what you experienced and the changes that you made based on those experiences. And so I think there's a few things I would even maybe go back to the point where you were. I don't know how brief this was, but briefly a financial advisor, and kind of it's an interesting thing that I think is worth pointing out, because a lot of people don't know the kind of limitations behind what your traditional financial advisor can actually advise you on without having a specific set of licenses and things. And it's all dictated by the
Yeah.
SEC. And so
Yes.
you made the point that you were essentially advising clients outside of what you were actually investing in. And so I'm sure that feels like a bit of a, I don't know, kind of tear you apart on you're pulled in different directions with that.
Yeah.
And I think that a lot of people get a financial advisor and don't know those dynamics that are in play. It doesn't mean that that financial advisor is a bad financial advisor or any.
Right.
It just means that's the limitations of that industry, and
Yep.
most of the time they're selling you what they can sell you, and that's going to be likely stocks, bonds, and insurance, unless you have any. Maybe you have more insight, but maybe you have something to add to that kind of point that I'm making.
Yeah, I think it's Right now, currently, I don't work with partners, whether it's a tax person, an attorney, a financial advisor, my self-directed IRA custodian. They all have to be real estate investors themselves. Where there's no point in me working with them, right? Because then they understand. And the problem with financial advisors, and it is not the advisor's fault, they are trained to sell the products that make money for their company and also that they think are the best products, right? But the reason they don't talk about real estate is because they're not compensated for it. As I said, they're not licensed, so they don't know anything about it, most likely. And it's scary, right? Alternatives are scary. They're hidden. You have to send wire transfers. It's very difficult to get into this world and understand it. And so, unless your financial advisor is part of a family office or is really sophisticated, they're probably not going to put you into real or point you in the direction of real estate, even because every time you take $100,000 to invest in a real estate deal, from their perspective, you're investing in something they don't understand. So that means it's scary and a bad idea, right? Also, on the other hand, it takes $100,000 out of the assets they are managing, and so they lose money. And again, it's not that they're nefarious or bad people. It's just that they're in this one world and they don't see anything else and they don't understand the rest of it. So once you kind of get out of that world, you realize that alternatives, they call them alternatives, but it's the place you live. It's the place you go to work. It's the place you go to buy stuff. It's every place you go, right? And everything you do is based in these alternatives. And so the other thing that when I look at financial advisors, a lot of them are, they work in this industry till they're 70 or 80 years old. And the question my mom always asks a new financial advisor is, if you're so good at this, why are you still working? And, that's a tough question to ask, but it's, as a financial advisor, there were guys in my firm that were 75 years old and still working. And I'm thinking, why? If you're so good at generating wealth, why do you still have to work yourself? And some of them just liked it. So no problem with that. But if you look around and you think, okay, I want to think about all the wealthy people I know, really wealthy people, or the ones I've heard of, I'll challenge you to find any of them that made that money in the stock market. They either buy businesses or run businesses like Warren Buffett, or they invest in real estate. And the tax code, penalizes people who have a W-2 and invest in the stock market, and they reward people who buy businesses and buy real estate, right? And last thing I'll say on this is the biggest thing that erodes your wealth is taxes. So if you just invest in real estate and do just as well as somebody in the market, you're doing better because you have tax benefits.
Yeah, yeah, I completely agree with all of that. And funny you said this, because I've mentioned it before that I hate the term alternative investments, because those alternative investments are actually the things that you're living in or
Yes.
working in, or like you said, like buying things that, like, they aren't alternative. They're like the things that it's a weird name for it. It's the whole industry is kind of interesting in that it makes it almost exclusionary in the sense that, we call it alternative assets, like it's this mystery world. It's not mystery.
Well,
It's
it is the people that named it, right? The financial advisors and Wall Street companies,
right,
right?
right. It's yeah. All it is it's not stocks. Like, that's really
Yeah.
what alternative investing means. It's, real estate, like you said, businesses. People do oil and gas. I don't know anything about oil and gas, but I'm saying, like, these are the
Yeah.
alternative things that are very real things that you use on a daily basis. So they're not
Right.
this like mystery. Like, it seems like people are more willing to invest in cryptocurrency as and like, that to me is, again, I don't know anything about it, and I'm not knocking that people shouldn't invest there. I'm just saying, like, you're investing in real estate, investing in businesses, investing in those things, like, that is real stuff that's around you at all the time, and it's understanding how to get in there. The other exclusionary component is just the whole part about accredited investors and the rules around it, and it does make it makes it hard to access without putting in some work. And I
Yes.
would say that's
And
probably on
that
purpose.
Yeah, and that part drives me crazy too, right? I hate that it's called alternative investing, and I really don't like accreditation either, because just because someone has $5 million doesn't mean that they know what to do with it, right?
Yeah.
They're trying maybe to protect people, but my point is, if you are somebody who joins a community like Passive Pockets, right,
Mhm.
that you should automatically be accredited because you've decided to
Yeah.
join a community and educate yourself in any community, right? So there should be other ways to get accredited, because you're protecting people maybe, but what you're really doing is hiding all of these investments from people so that they have to go to Wall Street because that's the only thing they know about or the only thing that they qualify for. So yeah, accreditation is a whole different thing that just drives me nuts.
Yeah. Yeah. Well, it and it does point to the importance of community, like you just mentioned, and it's
Yeah,
but people do have to figure some of this out themselves, right? So, I mean, the information
yeah,
is accessible. I can't tell you how many potential investors I've talked to, and hey, you need to be accredited to be in this fund. Are you accredited? No. I'm like, are you sure? They're like,
yeah,
actually, I don't know. And it's like, and they think
right.
that there's some. I feel like people think it's like being knighted or something like that. That like you get some, I don't know, like magical wand that gets tapped on your head and suddenly you're an accredited investor, where it's like
Right.
the rules are actually pretty simple, and uh, you can, well, you can take the Series 65 test now and become accredited, but I hear there are going to be some maybe even more accessible options for people, because it
And that
accredited is really about what it should be about, is education, like knowledge
yes,
around investing, not,
yes,
oh, I make X amount of dollars, or I have X amount of dollars of net worth. It should be about your education around the best use of your money, and the best use of your money isn't only investing in the stock market. Like it
right.
shouldn't be only that.
And the Series 65, it's unfortunately it's not that easy. This is the other thing that's frustrating is you go get your Series 65 and you have to, as they say, hang a shingle. You have to become
Yeah.
an agent for somebody, um, to get the accreditation for some operators. Now, each operator also, because there's no like black and white rule, some will say, "Oh, you have your Series 65, that's good enough." Others will say, "No, you have to have hung your shingle and have to be an agent somewhere." And so there's really no easy way other than building up your wealth. And it really, takes some people out of the game. In our community, we do have quite a few non accredited investors, and they are the most committed and educated because they have to work the hardest to
Yeah.
find deals where they can invest in.
Yeah. Yeah. No, that's absolutely true, because I mean, and for people listening, if you see a deal marketed on social media or something like that, it automatically can only be accredited investors. So
Right.
you have to you do have to work harder to get involved. If you have to find someone that's doing it and have offering deals that are uh, can include not accredited investors, but that means you already have to have an existing relationship with them. So there's all these rules and roadblocks that make it harder for people to grow their wealth in what is a very um, stable and lower risk asset. So
Yeah.
your it was a little bit of a tangent, but I think an important piece to touch on, because your path, Jim, sort of followed in a lot of ways. I think what people you had the accidental landlord piece, and then you decided, yeah, I'm going to get more real estate because this makes sense, which it does. But there are a lot of people that think, oh, I like the idea of getting in real estate. I'm going to go buy a single family house to rent out. I'm going to buy a duplex. I'm going to do something so that I can be a real estate investor. Again, not knowing that they don't actually have to be the person to do all of that work. And
Right.
I think that a lot of people find that out maybe the hard way. And so hopefully this your community of passive pockets, and talking about things like this on podcasts and is will be helpful for folks. Um, you did mention that being a passive investor, full time and passive investor, has some active components at least on the front end. So maybe talk a little bit about, and I'm sure some of this is what comes up when people come into the community, but just sort of talk about where people should begin if they hear this and they're like, yeah, I don't actually want to manage tenants, but I know real estate's a good asset class. Like, where would you tell them to get started?
Yeah, well, education, right? Learning about what you need to know is the first step. And that's where, again, communities are a good way to start. But, some of the things you need to think about is you're investing in a business, right? The business owns the real estate. You're going to be a part owner of that business. You're a limited partner, which means you don't have some of the liabilities, but you're still doing business with someone
Mhm.
in business with someone. So the key is you need to make sure that that's the person that you want to be in business with. So, we spend a lot of time vetting an operator and figuring out as much as we can about, is this a quality operator? Because one of the things, now there's advantages and disadvantages to every type of investing, right? And one of the disadvantages of investing in real estate syndications is these are long-term investments that are illiquid and completely out of your control, right? So if you're an active real estate investor and you need money tomorrow, you can sell your house tomorrow. Now, it might not be the price you want, but you can sell your house tomorrow or next week or whatever. But if you're in a syndication, you can't. You might
Yeah.
be able to find someone to buy it off you, but it's super complicated. You can't. You're illiquid, right?
Mhm.
And if you say, "Hey, I think we should raise rents more or we should, change our loan," you don't have any choices there, right? It's out of your control. So the key number one thing, and the cliche is bet on the jockey, not the horse, right? And so that separate the jockey is the operator and the horse is the deal. So we spend a lot of time vetting the operator. And if you like, I can talk about how I used to do it and how I've improved my process. But that's the most important thing, is to make sure you're working with the right operator.
Yeah, no, I would love for you to expand on that, and
Okay.
I think it's also important to hear if you did change that process and kind of what why. I think that'd be great, valuable information.
Yeah. So when I first started in syndications, I had a self-directed IRA from an old company that I rolled over, right? So I had a bunch of cash sitting in this IRA, and I went to a conference that was talking about syndications, and I wasn't sure if I was going to be an investor or an operator. And after about the first 3 minutes, they started talking about LPs. I'm like, yeah, that's me. These operators, that's not me. I don't want to do that. So I decided I was an LP. And then so I was very naive, right? Whenever I traveled for work before, I had to work company, paying for everything. And here I was on my own. I was pretty proud of myself that I actually went to this conference, spent my own money there. But then I thought, wow, so everybody, all the operators here must be fully vetted and approved by the conference, right? How else would they get here? Now, since then, I've learned that all you have to do is pay and you get to go. So none of them were vetted. And that's every conference, right? You're not vetting the operators. But I just assumed, I made some bad assumptions there. But so I just started kind of walking around the conference, and I'd meet someone with an interesting idea and I'd be like, okay, I'll invest in that. Here's some money. Here's some money. And just passing out money from my 401, from my self-directed IRA. So really bad way to choose operators, but that's how I did the first one. And some of those deals worked out. One of them is the worst investment I've been in, I think. And a couple others are fine, right? So it wasn't great. So then I said, you know what? That was not the way to do this. So I started listening to podcasts, right? Everyone's just going to podcast university. So that's what I did. So I listened to a ton of different podcasts. And when I hear an operator on the podcast, then I would call them up and I'd have a conversation for 30 minutes or an hour. So now I'd heard him on a podcast for a half hour. I talked to him for half hour, and now I'm going to make my investment decision. So that's way better than the first way I did it, but still, it's not great. I don't know if this person is a great marketer, a great podcaster, a great operator, all of the above, none of the above, right? So you really still don't know. And so I started asking for referrals, right? Tell me, give me 3 names so I can talk to people that are, invest with you. Well, obviously, they're not going to give me the people that didn't have a good experience, right? They're going to give them their brother-in-law and all the people that are the best ones. So also that still helped, right? All of those things helped, and I still do all of those things, but it really wasn't great because you can't get a sense of someone, and these deals last 5, 7, 10 years, right? So I can't just say, okay, I'll invest with this operator and then I'll wait 7 years to see if they were any good before I invest again, right? I have capital to allocate. So that's not an approach that really works. So what I do now is I do all that stuff I've done before, but now I don't invest with a new operator unless they're recommended to me by somebody in my community who I know, like, and trust, who's invested with them and has been in that investment for at least a year. So I'm not requiring that it goes full cycle. But what this does is it puts me way ahead on the due diligence, because let's face it, most people, when they send a wire, it's to buy a house, and that's terrifying, but you have your realtor right there with you, right? Sending wires are scary. So now I know, because somebody else has invested with this person, they sent a wire and it landed. So that's relief number one, right? Then I can ask the person, hey, how is reporting? Do they send quarterly reports or monthly reports like they promised? Yes or no? Okay, so now I know that. How about distributions? Are distributions coming like they said they would in the pro forma? And if not, have they explained why? And is that reason good? Right? So, because once you invest, once you send that wire, the only thing you have are reports and hopefully distributions. So I want to make sure that all that is there. And then I do some other things to make sure that they're effective communicators. And, so once I've done all of that and I've gotten my referrals and stuff, they'll send me a deal and I'll look at the deal. And, at Passive Pockets, we have a deal analyzer, which kind of helps you find red flags. Not that these are, red flags that, the deal's going down, but just things to generate conversation. Oh, why are you saying you're going to get 6% rent increases when the market's at 4% or whatever it is? And so I'll send an email and ask all those questions. And then I'll wait and see how the communication is. Do they respond to me within 24 hours? Or if not, do they have a good reason why? Do they, reply? All those are answered in the webinar. Well, okay, I already watched the webinar. So if you're going to send me an email like that, I'm probably not going to invest with you, right? Because you're not going to communicate with me. Yep. And then once I get the answers, then even if they've answered everything, I'll come up with some new questions, just because I want to see, like, are you really going to take me seriously? I'm a little bit of a hassle, maybe. Are you going to be okay with that? And so then I just want to kind of check their communication, because let's face it, if they're not going to communicate with you in the way that you want before you wire them $50,000 or $100,000, there is no chance they're going to do that after they have your money. And communication is the only thing you have once you send that wire. So that's kind of how I look at vetting an operator.
Yeah, I mean, I've heard people talk about a lot of different ways, but I think that's very, very smart. And I think that the communication piece is for sure. I mean, it's got to be spot on. I mean, I am an active investor. I have my own deals, but I also invest in other people's deals. And it's like, I've seen things go bad. And what really matters is the communication around that. Like are you doing what you say you're going to do? Are you, giving us updates on the this thing that's going bad? And it's like, it's a lot easier to accept that an investment, didn't work out when that operator did everything they could possibly do and they communicated, through that whole process. Like, that to me
right.
makes all the difference in the world.
Yeah, and let me add to that. You said through the whole process, and that's for sure. Like, if a deal's going bad, before yesterday, right? And deals are going to go bad. It's investing. It's not called winning every time, right? So some deals are going to go bad. But if you know about it, 6 months or a year ahead of time, then you need to be telling me, here's what's happening. We're doing our best. Here's what we're doing to mitigate it. But what happens is, a lot of times when things aren't going well, they'll try to hide it and think, I can just perform us out of this. Yeah. And then what ends up happening is they send out a quarterly report like, yep, everything's good. And then the next week you get an email, hey, there's a capital call, or hey, this is the problem. And they haven't been sharing that the whole way. So if I'm invested with somebody and they have a deal go bad, that doesn't mean I'm not going to ever invest with them again. Mm-hmm. The way they can get me to never invest with them again is to not communicate. And it doesn't matter if you give me a 2 or 3x or I lose a little bit of capital. If you aren't communicating, I am never investing with you again, because this is this is part of the reason I choose to invest this way, right? I used to be invested in Apple stock, right? But when things went well or things went bad, I can't call up Tim Cook and say, hey, buddy, what's going on? Right. And I don't expect him to say anything to me except for, in the quarterly reports. Well, if I'm investing with you in this type of investment, I expect that I could pick up a phone anytime and call you and chat about my investment. And if you're not willing to chat about it, then I don't want to invest with you, because that's one of the benefits of this type of investing. Now, I don't have any control over it, but I can give you a piece of my mind and say, hey, here's what I think you should do, or hey, what's going on?
Yeah.
And so that's just how I look at it.
Yeah. It's a, I don't know why, but we have apparently all of the same examples, because I agree. I think that is like access to the operator is one of, maybe two or three truly defining distinctions between a syndication versus investing in the stock market that does
Right.
make it better. And that access to whoever's in charge is a huge piece of it. And I've used that exact same, like, I love Apple products. I think it's an amazing company, but I'm never going to talk to Tim Cook. Like, I'm never going to
Right.
have, and if the stock, drops by 40%, they're not going to call me and say, hey, this is what happened. Like, it doesn't, there's no, there's just no access there. And I think that in syndication, in the syndication world, like, that has to be our thing. That has to be
Yeah.
our, I guess, defining or our characteristic that sets us apart from, because otherwise, yeah, you might as well just invest in it. Like if you don't get to know, you don't get to know what's going on, good or bad, you don't have access to anything. It's not a whole
What
lot
are you
different.
doing?
So I think it is truly, almost the maybe the most important distinction between
Yeah.
stock investing versus syndication investing is that you have direct access to whoever is pulling the strings in that syndication. You should have direct access to them. So
Yeah. And
um,
I would add one more thing if I can.
yeah,
And I recently added this into my operator screening, right? Is, again, long term. We're going to be together 5-7 years. I'm a partner in your business.
mhm,
So I'm not investing with anybody who I don't actually like, right? Because
yeah,
it makes a difference. If things are going bad or things are going well, and I just can't, and you're so annoying, not you, but the person is so annoying that I don't want to talk to them,
yeah,
then I'm not going to talk to them and ask them about the deal. I'm going to avoid it. So I'm going to do business with people that I like. And that was a new one, but it because I've gotten into a couple of deals where I'm like, okay, this is a great deal. I trust the operator. Everything's good, but I'm just not sure about them as a person. Like, I wouldn't go sit and have a beer with them or want to chat with them. And it shows up in the investment eventually. And that's why, now that's kind of a new one where I just want to be able to have a pleasant conversation with someone before I send them my money.
yeah. I couldn't. I mean, people use that no like and trust thing, and I think the like part of it probably gets passed over a little bit
Yeah.
in the sense, but yeah, I mean, it really does matter. Like they're you are partners. You don't have to be best friends, but you are partners, and it, as you said, it's an illiquid investment that you're going to be have some level of relationship with that person for a long time, and so just
Right.
being able to it in a lot of ways the 506B, like, non-accredited criteria for being able to invest are that's kind of the one thing that makes the most sense in all of the like all of
Yeah.
the
Yeah.
SEC rules is like you actually have to know that person and have some level of relationship with them, and it's like that probably would be that and some level of base knowledge as far as investing. Like, those two things would probably be the most important thing in terms of getting into the syndication space. um, so a lot of people love the idea of being, or they think they love the idea of being a completely passive investor. Um, I personally see that as my maybe long-term goal is to get, more and move more and more of income from active to passive. What does that you've got this community, and so um, you're not doing nothing. And I think that is something that maybe goes with the picture of someone who's just passive investing. But I think that you're not actually doing nothing. You're just doing the work on the front end and not having to manage the assets. I was hoping you would talk a little bit about just kind of what that looks like for you. I think one of the things that we've talked about on the podcast before, and that I think is important understanding, is sort of the tax benefits, that you don't have to make as much money as a passive investor in a syndication as you do having a job, because of the way those things are taxed. And we touched on it a little bit, but I just
Mhm.
would love to kind of hear your take on kind of the lifestyle of being, sort of a professional passive investor.
Yeah, I think the best way to really understand it might be to think about retirement, right? And let's say we have person A and person B, or we'll be Jim and Jason, right? And Jim, I invest in the market, and you invest in real estate, right? But we're going to retire, and we both have $1 million, right? So for me, I have $1 million, and my financial advisor is going to say I can only take 4% out per year, because the hardest part about investing for retirement is you don't know how long you're going to live.
Mhm.
So I have to keep that $1 million at $1 million through up and down markets, right? So I take out 4%. That's $40,000. Let's assume I have to pay 25% in taxes, so I net $30,000. That is probably the most I will ever earn, because I keep taking money out. So even if there's stock market gains, that $1 million is not going to grow. And if there's a big downturn, it's going to shrink, and I'm taking money out. So it's gonna be real hard to build that back up, right? So I'm earning 30 grand a year, and that's it. So for me, I just have to accumulate, right? That's all that matters, is accumulate, get as much, build up that $1 million as big as it can be, so that I can just take my little pieces out of it. Well, Jason, you're smarter than me, so you are the real estate investor in syndications or active real estate, whatever. You have $1 million. Well, pretty easily you can earn, let's say, 7% cash on cash return off of real estate. So you're at $70,000. So you're already winning. And then you're not going to have to pay taxes if you do things right. Legally, not going to have to pay taxes. So you're at $70,000 annually is what you take home. And that is forever, because your $1 million is you're not taking money out of it. You're
Yeah.
taking the cash flow from it, the operating cash flow from it. So your $1 million is probably going to double every 5 to 10 years. And that means your cash flow is going to keep rising. So when you ask the question, how do you deal with being a full-time investor? That's how you do it, right? It's a snowball that keeps on growing. And after a few years, you're going to, let's skip the retirement, just regular living. You're going to find out, okay, invest $25,000 or $50,000, let's say $50,000 in a deal, and maybe it pays a 7% pref or 8% pref. That's like $333 a month, right? And so you're going to send this wire for 50 grand, and you're going to get $333 a month. And you're going to be like, okay, maybe that's part of my car payment.
Right.
But
Right.
you're going to notice you do a couple more of those, and then one goes full cycle, and you do some more. That little snowball, a few years, and you're going to be like, oh, wow, it's paying my mortgage. Oh, wow, it's paying everything. So that's kind of how I look at it. Now, there are difficulties, because, as you know, it's been a tough few years, and a lot of people have stopped distributions, right, to hopefully save their deals. So as a cash flow investor who doesn't have a full-time job other than my investments, I have to monitor that and make sure that I'm well diversified. And that's why I think partially debt funds have become so popular, because they are paying out cash flow 6, 8, 10, 15%, depending on the fund. And that can help me get through the tough times when my 7% aren't coming. Now, these 7% are being stored up because they're preferred returns, and hopefully they'll come back. Hopefully the deal goes well, and I'll get those 7% still. But the cash flow is bumpy.
Yep.
And so, you can't just look at my example of, okay, he said $1 million, 7%, I'm always going to have 70 grand. That's an example, right? It doesn't happen the only thing I can guarantee is if you have $1 million, you're never going to get 70 grand, right? It's going to be more or less or something in between.
Yep.
But the point is that you just have to be prepared for a rocky road. it's so you want a big cushion and buffer when you make the decision. And that's why, everyone needs to figure out, what does financial freedom mean to me? And is it, I want to be completely done with my job? Do I want to be half done with a job? And so you can kind of work your cash flow into those, whatever those goals are, but you really want to make sure you have a considerable buffer before you make any drastic decisions, because again, it's out of your control. If distributions stop, you still got to feed the family.
Yeah. Yeah, I love that, the way you put that and kind of painted that picture. I think the you're absolutely right. It is going to be, it's not going to be a straight line, right? It's not going to,
Right.
and no investment is. And the thing is, like, people invest in the stock market, they put in money with their financial advisor. We've talked about this. Like, it's not a straight line there either, but they're also not watching it close because they think someone else is, and they didn't have to write a $50,000 check. They put in a little bit of
Right.
money here and there, kind of thing. So,
Right. But
it,
the just one thing, the in the retirement example, they do have a straight line at the 4%, right? You can't really be able to take out more than that. So that's your straight line. And that's not good, because even if your portfolio goes from 1 million to 800,000, you can't then say, well, I'm going to take out more this year, right? You should actually take out less.
right.
So that's the problem with the accumulation strategy, is you're just accumulating, but you don't know what your number, they give you a magic number, but what does that mean? Who knows? You don't know what your lifestyle is going to be like in retirement. You don't know what inflation is going to do, or cost of good, any of that. That's why having consistent cash flow that matches or beats inflation is the way to go.
Yeah. And and the, the point that, I mean, that's 100% true. And I guess, yeah, the retirement example, there is a straight line, but it's down instead of up,
Yeah.
because you're just drawing off of that. But yeah, the idea that, real estate assets increase in value over time. And so your $1 million in 5 to 10 years is $2 million, but it might be, sometimes it's $2 million in 4 years, and sometimes it's $2 million in 10 years. It's not going to be,
Right.
it's a straight line in that. But the point is, those cycles just keep going on. I actually built out this whole spreadsheet because I wanted to, mostly because I was thinking about it in terms of my kids. But I'm like, if I'm putting money towards passive investments for them over time, and they continue that process, like, what does that look like? Because my kids are young, and if they have, at 60, that's many doubling cycles.
Yeah.
It gets big quick, even if you start with just a little bit of money. So it's kind of the message I'm getting at from what you were saying is, like, understanding that those things are going to go up while you're still getting that cash flow, because there's rents and, all of that, so that they're income producing assets. So I think it's just, it's different. And I don't think that people necessarily shouldn't invest in the stock market, but it's like, there are other and better options, and unfortunately they get called alternative, but
Yeah.
but they're out there, and very accessible to you if you just do a little bit of digging. So, Jim, let me, I mean, this is all a very fascinating topic to me, and I'm been shocked at how many similar examples we use in trying to explain these
Yeah.
concepts. But I want to make sure I get the time to ask you. I ask every guest. The name of the show is Know Your Why. So I ask every guest, what is your why? What's your path? I think, in the real estate space is not uncommon. I think a lot of people think, I want to get it. They sort of accidentally find out real estate's a good idea. I want to get into it. I have to do it by, you know, getting myself a house or a duplex or something, and then get to the point where, syndications can be a big part of it. But you've got this community you've built. I mean, what is driving you now? What is your why and kind of reason to push forward?
Yeah, I think there's two very related reasons. One, personally, I want financial freedom, and that means to me time freedom, location freedom, and I want that for me and my family to be able to enjoy the time that we have here in ways that we want to enjoy it. So that's one part of it. But really, my passion is, you know, I've been an educator my whole life. In every job I've been in, somehow I've managed to find myself in a place that I can educate people. And so I really like that, especially interested people, which is why it was hard being a teacher of kids, right? Because they're not super motivated to learn, and I do not blame them. But my passion is to help people understand that there is a better way to do this, right? Money is a necessity, wealth is a necessity because you need it to function in our society, right? So we're going to get away from the argument whether it's good or bad and all that. It's necessary. And so I want to teach people that there is a way to financial freedom, whatever that means to you, right?
Mhm.
And the hard way is work a W-2 and throw a bunch of money in your 401k, retire and hope, right? That's the hard way. And it's not the easy, the alternative isn't the easy way, but it's the more efficient way. And that is, having a way to generate cash flow that will eventually exceed your expenses so that everything for you becomes optional when it comes to work and money and all of that. It all becomes optional because you've covered your expenses and you're good to go and it's sustainable. So my passion and my why is to show people that yes, it's doable regardless of who you are, what stage you're at, right? This is something you need capital for, right? You're not doing a house hack for a syndication, but young people can get into this. People in the middle of their career, into your career, there's always a space for this. And my mission is to share with people, you can do this, we can help.
Yeah, no, I think that's it. I really love the idea of a community for people to learn about passive investing and having, obviously, kind of that referral type system where they can, talk with other people who have vetted a sponsor, get a little bit higher level of comfort in the investments they're making. So when people hear this, Jim, and they want to connect, maybe join the group, what's the best way for them to reach out and sort of be a part of what you're doing?
Yeah, go check out passivepockets.com. We have a 7-day free trial, so you can jump in, and we have a forum, we have investing tools, we have like a Yelp review kind of star system for rating operators that you can check out. So there's a ton of content on there, and we do deal reviews where we have experienced LPs who come on and talk to an operator, ask them all the tough questions, and then we discuss amongst ourselves afterwards. That's been pretty popular. So there's a lot, and we have the podcast. There's a lot of content there. If someone wants to reach out to me personally, I'm also happy to do that. You can do that through the direct message me on Passive Pockets, or you can send me an email at jimpfeifer@biggerpockets.com. I spend a lot of my time talking to LPs, so I'm always happy to have a conversation.
Fantastic. We'll get all that in the show notes so people can find you easily. Thanks for coming on the show today. Thanks for sharing all this. I think such important topics and things for people to understand, just in terms of what is available to them in ways to essentially better their future and create some level of financial freedom. So thanks for being here and sharing with us, Jim.
Thanks for having me on. It was fun.
Folks listening, please make sure you connect with Jim. And rate, and review the show so we can continue to get great guests. As always, thank you for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?